In this video, I'm going to discuss four major categories of data analyses. But I want to be clear that even if I'm giving you four buckets with which you can approach or classify any given analysis, there are many, many different ways that you can approach data analysis. There are lots and lots of tools, software platforms that are out there that incorporate a variety of statistical procedures. So there are limitless ways to go about any given analysis. This framework is pretty universal to the analytics community, and it's going to help you structure your thinking for any given project and be able to communicate what you're doing with others. These four categories are descriptive, diagnostic, predictive, and prescriptive. Our roadmap for the rest of this video is to define each individually, and then we'll discuss ways to compare and contrast these approaches collectively. First, we have descriptive analytics, which answers the question, what happened? This category focuses on summarizing and presenting historical data. Common tools could include summary statistics like those you've already been calculating in pivot tables. When we break out the average of a field by various categories, that is a form of descriptive analytics. You are describing what has happened historically. As it relates to visualization, dashboard reports are common here. As an example, a company might use descriptive analytics to find out total monthly sales by region. This is the most basic form of data analysis. Next is diagnostic analytics, which digs deeper to answer, why did it happen? This involves identifying patterns and correlations in the data, so techniques like drill down analysis and regression are frequently used. Imagine a business wants to know why profits declined last quarter. Diagnostic analytics will help pinpoint the underlying causes. Moving forward, we have predictive analytics, which focuses on forecasting future outcomes by asking what will happen. This category leverages historical data to understand trends and make predictions. Tools like time series forecasting and statistical modeling are key here. For instance, predicting next quarter sales is a classic example of predictive analytics in action. Lastly, prescriptive analytics answers the question, what should we do? It builds on predictive analytics to recommend actions based on data insights. This often involves optimization, machine learning, and simulation algorithms. For example, a company might use it to determine the optimal level of inventory to minimize costs while preventing stockouts. There are a few dimensions where we might compare and contrast these different categories of analyses. The first one relates to time. Descriptive and diagnostic data analyses are inherently backward-looking. The objective for these is to understand historical events. Predictive and prescriptive are by definition forward-looking. Sure, we still might be working with historical data, but the objective of learning from the past is to forecast what is going to happen in the future, and given these forecasts, what course of action we should take. We can also draw a vertical line to classify these categories. For instance, one could argue that descriptive and predictive analytics tend to be more outcome-focused. The ultimate output of each of these is a table or some sort of numbers. What were the results of the past, and what do we expect future outcomes to be? Diagnostic and prescriptive analytics seek to dig a little deeper, to gain a deeper understanding of the underlying causal mechanisms, and to explicitly chart a course forward. You might say that these are more action-focused analytics. One way to visualize these approaches is across the dimensions of value and difficulty. Descriptive analytics tend to be simple, but the insights offered as a result are also less valuable. On the other end of the spectrum, prescriptive analytics have reached the point where formal recommendations about what to do are being offered, and that sort of decision support makes them incredibly valuable. But developing the models and algorithms to get to that point can be complex and costly. Honestly, you can consider financial accounting as the beginning of a process that touches all four categories. It all starts with the preparation of financial statements. Accountants use their expertise and generally accepted accounting principles to capture economic reality and summarize it using debits and credits. At the end of each period, we put together the ultimate output of all our hard work. the general purpose financial statements like the balance sheet and income statement. And we can consider this descriptive analytics. With financial statements, we can make arguments about what happened historically. Financial accounting information is backward looking per the FASB conceptual guidance. But while we, the accountants, view financial statements as the finish line, they are really the starting place for a series of additional analyses. Institutional investors and financial analysts will take these financial statements and engage in financial statement analysis. They might be able to see what net income was this year and last year from the financial statements alone, but they will want to know the underlying causes for changes they observe. They might calculate key ratios or benchmark the firm's performance to other industry peers to better understand the why behind outcomes with these diagnostic analytics tools. Next, they're going to take the information they've gleaned and plug it into some sort of an earnings forecast model, a type of predictive analysis. And maybe they're considering more than just firm-specific performance. Analysts will also likely monitor overall economic conditions when calculating an estimate of next quarter's earnings per share. But in the end, investors don't care about EPS on its own. Analysts will need to analyze the entire set of investment opportunities and make a recommendation to either buy, hold, or sell the stock. The fact that the analyst is suggesting a course of action, this allows us to refer to this as a type of prescriptive analysis. So hopefully this helps give you a new perspective on how accounting itself is analytics, and while the financial statements themselves are only descriptive by nature, they are the launchpad for many decision makers to engage in additional analyses and extract tremendous value from them. As a final exercise for you to assess your learning, I've prepared 4 business contexts where each of the analytics categories are in play. Your job is to read through each of these and match them to whichever type of analytics is being employed in each scenario. So you know the drill. Pause the video now and take a stab on your own before listening to my answer. Let's take the first one. An e-commerce company uses past purchase data to forecast which products are likely to be in high demand during the upcoming holiday season. Okay, let's look at some key words there. We are looking at past purchase data, but what is the purpose? To forecast something. We're looking in the forward direction. And that on its own, it's leading us to be a predictive analysis. We're not deciding what to do with that information. We're simply trying to see which products will be in high demand. Moving to the right, we have a marketing manager reviewing last quarter's sales report to identify the top selling products, summarizing overall performance. Anytime you see that word summarize, we're not trying to do anything else with this information. We're just reporting something. So that's our most basic level there, descriptive analytics. Next, after noticing a decline in customer satisfaction scores, a hotel analyzes customer feedback to identify common complaints and underlying issues. Identifying common complaints, that to me actually feels still descriptive in nature, but that last term, underlying issues, we're trying to see why customer satisfaction has declined. And that why leads us to think of diagnostic analyses. Well, by process of elimination, we know we're going to end this with prescriptive, but let's look at it. A logistics company uses optimization algorithms to recommend, there's a keyword there, the most cost-effective delivery routes to minimize fuel consumption and delivery time. Since these algorithms are explicitly suggesting a course of action, we know this relates to prescriptive analytics. Major takeaways include knowing the 4 categories of data analytics. Descriptive, which seeks to know what happened. Diagnostic, which aims at why something happened. Predictive, what will happen in the future. And prescriptive, what should we do about it? Ultimately, you want to be familiar with these to know the kinds of tasks and tools that are common for each.